Last year, these 5 stocks looked like total disasters, worse than gas station sushi during a heat wave. But fast forward, and they're now crushing the market, up an average 11.6% and beating the market by more than 20%. Hey Bowtie Nation, Joseph Hogue here with the stocks everyone gave up on last year, written off and thrown out by Wall Street, but making double-digit comebacks. I'll reveal those 5 worst performing stocks from last year, now producing giant returns against a market going nowhere but down. But before you start thinking the secrets to success is just buying the biggest losers, I'm also going to show you 5 others that fell just as hard and are still lying there like a dropped meatball in a Denny's parking lot. Nation, this isn't about dumpster diving the market's rejects. It's about learning how to do value investing the right way, how to spot companies with turnaround potential and not just cheap prices. I'm going to walk you through what separates a temporary slump from a long-term slide and show you the stocks to buy right now. Let's get started with one I recommended on the channel in December, Humana Inc., ticker HUM, the 7th worst stock last year, down 44%. But that has now rebounded this year to beat the market by double digits. Now, all 5 of these stocks were up nearly 20%, and while some have come down in the recent crash, they're all still beating the S&P 500 market index. Humana was on my turnaround list to begin the year on potential changes to Medicare and the Medicare Advantage programs. The last several years saw reduced payments from the government to that MA plans, along with harsh restrictions on marketing. That could be about to change, though. Trump's nominee to run the Centers for Medicare and Medicaid, Dr. Oz, has been an aggressive proponent of transitioning people onto Medicare Advantage plans. Humana is the 2nd largest provider with 18% of the Medicare Advantage market and booked strong growth of 472,000 enrollees over the last year, an increase of about 8.5% over the previous year. Humana offers Advantage plans in 89% of counties across the country, more than any other provider, and is adding benefits to its 2025 plans like music therapy and dual-eligible special needs plans. Prescription drug coverage is also changing for its 2025 enrollment, with a $0 copay for Tier 1 and Tier 2 drugs through its mail-order pharmacies. On $125 billion in forecasted sales this year and a return to just 0.4 times price-to-sales multiple, which is still low versus historical averages, the stock could be worth $400 per share, or 56% higher than the current price. We're just getting started, counting up to the best rebound stocks of 2025, with one up 48% just in the first 3 months of the year. First, I want to thank our sponsor for today's video, StoryWorth Memoirs, one of my favorite ways to capture and share memories with family and loved ones. As some of you out there in the nation know, my mom passed away about 8 years ago, which means Michael was just 4 years old and Samantha wasn't even in the picture yet. But then with StoryWorth, the kids have been able to feel that connection with their grandmother through this book that I put together. Here's how it works. You can buy StoryWorth for yourself or for a loved one. StoryWorth is going to email you 1 question each week about their lives. Capturing the stories is easy, simply by replying to an email or even recording it over the phone. And at the end of the year, these stories, along with the photos you add, are bound into a hardcover book. Now you can see my book here with my mom responsibly holding me over the balcony railing, as every good parent has. I filled it with all the memories I had, but the StoryWorth prompts were super helpful in bringing up more memories and being able to fill it out to a complete picture. Here I remembered things I hadn't thought of for years and got to review those old family photos, all of which was really nice to relive. I'm going to leave a link in the description for an exclusive $10 off, or you can scan the QR code in the corner. Check out StoryWorth. It's been such a great experience for the kids, and I'm gifting it to others in the family. With Mother's and Father's Day coming up, it could be the perfect gift for a loved one. Back to our list, and shares of Dollar General, ticker DG, were the 8th worst stock in the S&P 500 index last year, down almost 44% for the year, but have rebounded, now up 23% in the first 3 months of the year. Dollar General has nearly a 100-year history in its local retail stores, now almost 20,000 stores across the country. Competition with Walmart, Amazon, and more recently with a weakening low-income consumer has seen those shares lose 2/3 of their value since the 2022 peak, including last year's plunge. And here, while competitor Dollar Tree is also up for the year, Dollar General rebound is more than just a bounce off those oversold conditions. That 23% rebound follows a comprehensive review of the store's portfolio and a plan to close 111 underperforming stores, while also growing the store count in those profitable areas. Fourth quarter earnings saw revenue up 4.5%, with same-store sales up 1.2%, both better than last year's trends. The sales this year are expected to continue at a sluggish 3.7% pace, though we could start seeing the benefits of that cost-cutting plan and an 8.6% increase in earnings to accelerate in the coming years. Our shares are still relatively cheap here at 0.46 times sales, and a bounce back to that average of 0.6 times multiple would mean a $117 share price and a 35% upside. But this one has a very high amount of debt, one of the warning signs that I'm going to show you later. Next, Nucor, ticker NUE, just made the list of worst stocks with a 32% loss last year, and were up almost 10% this year until a recent market crash. Now down 10%, they're still beating the market and I think have some strong rebound potential. And here Nucor exemplifies one of the clues I'll show you next in knowing which of these stock losers could become leaders, a change in the big picture macro environment. Nucor is the largest steel and steel products producer in North America with a 70-year history, but has for years fought against surging imports with steel tariffs watered down with exemptions and falling prices. The promise of higher tariffs saw a 16% surge in the stock after the election, but then uncertainty took over and brought the shares back down into the new year. Then, in the lead up to tariffs and the March 12th implementation of 25% duties on imported steel, the stock has seen its renewed life. Those tariffs and the optimism by management has led analyst upgrades, with UBS rating the stock for a buy and a $160 price target. Further upside on Nucor will depend largely on how long tariffs stay in place, but on forecast for 3.2% sales growth this year to $31.7 billion, their shares are still cheap at just 0.85 times price to sales. On forecasted sales and back up to 1.15 times valuation, the stock could be worth $149 a share, or 44% upside. We've still got two of the biggest rebound stocks, two stocks that have jumped 20% plus. But you know this channel isn't about just dropping a list of stocks in your lap. Nowhere is it more important that you know how to analyze these stocks than in this kind of deep value investing. That's because when a stock gets crushed down 40, 50% and more, it's easy to see a bargain. Investors start shouting meaningless cliches like be greedy when others are fearful as a sole reason to load up, but not all deep value stocks are diamonds in the rough. Some are still wet stocks in a porta potty. Cheap, yes, but you really don't want to pick them up. For example, not all last year's worst stocks have become millionaire makers. Within the worst 15 from last year, 5 have lost an additional 14% on average, with their investors still hoping they can afford ramen noodles. Understanding then how to tell which stocks will rebound and which will ruin you is everything in value investing, so I want to detail the 3 factors to watch for, how to analyze deep value stocks. And first, too much debt is the biggest red flag for deep value stocks, and one I've missed out on in the past, losing a lot of money because of it. Leverage can help a company grow sales faster, but an over-leveraged company loses flexibility. If earnings fall even temporarily, the interest payments don't stop, and it can turn good stocks into zombie corporations. That's because highly indebted companies can't reinvest in the business, can't pivot their strategy, and may need to sell their assets at fire sale prices. To check debt on a company, you can go to the balance sheet within the financial statements, click through to total liabilities, then non-current to see all the long-term debt and how it's grown over the last few years. Here we can see that Lamb Weston has had to borrow increasingly more, ballooning its debt from $2.7 billion to over $3.4 billion in the last 3 years. The Statistics tab helps you put this into perspective. If you scroll down, you're going to see the debt-to-equity ratio. While there's no cutoff for the danger zone, anything over 100% debt to equity is definitely a warning sign. Now, harder to spot here, but just as important are those macro or big picture changes to a company's sector or industry. Whether it's the economy, regulations, or technological disruption, even a well-managed company may be doomed until that tide turns. A good example of this is the market for office real estate stocks. Not only did the jump in interest rates drive the entire commercial real estate market into a recession, but office property never recovered from that work-from-home trend after the pandemic. The 5 largest office REITs are down 40 to 92% from their pre-pandemic prices and continue to fall. Understanding that bigger picture and how it affects a specific industry or a stock is where your emotions are going to be tested as an investor. Folks, too many investors get emotionally invested in a stock, only looking for that bull case and why it should be a screaming buy. Instead, you have to consciously look for the bear case argument, the articles, the videos warning investors, and decide rationally if there's a good reason that the big picture is going to turn for that stock. And third here, you cannot overlook management quality in a value stock. Good management cuts costs, pivots strategy, and takes responsibility, while bad management doubles down on failed strategies and masks problems with accounting shenanigans. For example, even though shares of Intel have jumped this year, it's only been on the relief of dumping former CEO Pat Gelsinger in December. Over the last 3 years, Gelsinger continued to burn cash trying to design and fabricate semiconductors, something I pointed to in 2022 would ruin the company already struggling just to design chips. Over his tenure, Gelsinger destroyed more than $150 billion in the stock's value, while collecting over $50 million in compensation. So before buying any turnaround story, dig through those past earnings calls and the 10K annual reports. Is management being honest about the issues? Are they making the tough decisions, or just rearranging deck chairs on the Titanic? For that reason, the one stock I'm still not quite sure about, shares of Intel, ticker INTC, the second worst stock last year with a 58% loss, but now posting a giant 18% rally this year until the recent sell-off, are still a bargain, beating the market by 13%. Again, I've been pointing out for more than a year that former CEO Gelsinger's dual strategies of not only designing semiconductors, Intel's traditional strength, but also trying to fabricate them was a huge mistake and virtually guaranteed the company would do neither of them well. Intel hadn't designed a competitive chip against AMD or Nvidia for years, yet under Gelsinger, it wanted to also open up another front competing against TSMC, which fabricates 90% plus of the world's high-end semiconductors. So then that madness came to an end when Gelsinger was shown the door last December, but not before destroying that $150 billion in shareholder value and collecting that $50 million paycheck. So the rebound here is completely on that change in management and a hope that this once undisputed leader in semiconductors can find its way again. The new CEO is less than a month into his role, and reports are that he plans to continue building out that dual strategy of fabricating and designing, so might not be the holistic change the company needs. And for those reasons, this one more than any other is hard to value because we just don't know what changes are coming or if they'll even do anything to put Intel back on track. On forecasts of no sales growth this year to $53.5 billion in revenue, the 1.8 times price-to-sales ratio is a huge discount to other chip makers. For example, even after the crash, shares of Nvidia trade for 19 times on a price-to-sales multiple. Even a 3x valuation multiple would be cheap if Intel can stage a turnaround. That would be a 64% return at $33 share price, but it's a giant uncertain right now. This next stock has doubled the rebound return of any other on the list, up 48%, but these aren't the only stocks I'm buying on that recovery potential. Check out the 7 stocks in the video linked in the corner here for the best buy-the-dip stocks this year. Stocks trading for as much as 61% discount to fair value. And the biggest rebound stock so far this year, shares of CVS Health, ticker CVS, which were down 40% last year and the 9th worst stock in the S&P 500. Now up 43% just in the first 3 months of the year. Now, I highlighted CVS as a rebound stock in December on that turnaround in Medicare Advantage as well as some other factors. While it has a smaller part in the Medicare Advantage market, just 12% of enrollees through its Aetna Insurance acquisition, the company has been one of the most aggressive at growing its MMA business over the last year, increasing enrollment by 758,000 people, or 22% above last year's numbers. But then CVS has also benefited from a wave of other changes beyond that potential in MA plans. The company caught investor activists into attention with a $700 million investment from Glenview Capital in September. CVS then hired a new CEO last October, implementing a $2 billion cost-cutting plan to stabilize those earnings. Then fourth quarter earnings beat expectations with revenue up 4% on the year, while the pharmacy segment did especially well with a 7.5% sales increase. That earnings beat and the optimism over new management working with the activist investor for a new path led to analyst upgrades and should drive real change for this deeply discounted stock. Now that said, the fast money has already been made here, but on forecasted sales of $390 billion, a return to 0.3 times on that price-to-sales valuation could bring a $93 share price target, or a 38% upside from here. Look for the link in the description for an exclusive offer, $10 off StoryWorth to capture and share your memories with your family and loved ones. Or click on the video to the right for 5 life-changing stocks to buy right now. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.